So a few days ago, Cathie Wood, the CEO of ARK Invest, posted a string of pretty crazy posts about her thoughts on the market's outlook and inflation, though for market outlook, she spends a lot of time talking about events from over a century ago. She opens by saying how she believes inflation is unwinding. Now, it's not at all unexpected that she has a bullish outlook on the market and specifically tech, but to say that she believes inflation is unwinding seems way overly optimistic right now. While we finally did get some good news from the most recent CPI report, inflation is still extremely high and there are still a lot of supply chain issues that need to be solved. But this is honestly just the tip of the iceberg with the level of blind optimism in some of these tweets she has. So she follows this up by making some pretty cherry-picked comparisons of the 1920s and the 2020s, talking about how, for example, the Spanish flu is like COVID, and she brings up World War I, although I'm not really sure what she's comparing that to today because she doesn't exactly specify here. But that's a pretty important point because World War I was obviously a massive source of stimulus to the American economy headed into the 1920s, and I don't really think there's anything comparable to it going on right now. Anyways, she then goes on to talk about how bad the Fed is, which I can actually agree with her on, seeing as how poorly they've managed interest rates since inception, and interest rates are literally the thing that they're supposed to manage. Her only problem here is that she starts making predictions like saying inflation could go negative next year if the Fed continues, which is like maybe if the Fed raises rates astronomically and the supply chain finds a way to fix itself, could happen in like a couple years, but this seems like a crazy prediction to me for now. So yeah, her next few tweets here really bother me, and she kind of continues the cherry picking here with numbers. So she starts by comparing a less than twofold, as she says, rise in rates from 4.6% to 7% in 1919 to 1920, to a rise in rates from literally 0.25% in I think 2020 to now being around 4%, and describes that as a 16-fold rise. Like by this logic, the Fed raising rates from the original 0.25% up to just 0.5% would have been greater than the raise in rates in 1919 because it would have been, as she would say, a full two-folds. Now, as if that isn't dishonest enough, her next sentence is about how lowering rates back down to 4% in 1921 triggered all these great returns in the market for the next 8 years. Although I guess there's a really, really big emphasis on 8 years here because in 9 years, all this market overspeculation that she's referring to actually led to the biggest depression in the history of the world. Now, she tries to blame the stock market crash on a rise in interest rates and the Smoot-Hawley tariffs, even though the Smoot-Hawley tariffs were actually passed in 1930, which was after the market crashed. Then, on the other hand, while the interest rate rises might not have been helpful to the economy at that time, she fails to see, obviously, how overspeculation was the real issue here. And to demonstrate this point, in her last tweet, she even points out how the compounded annual growth rate of the Dow was 25% for 8 straight years leading up to this market crash. Which is absolutely insane, by the way, because the Dow, since it can first be tracked, has averaged around 5.42%. To demonstrate how much she's overlooking here, I actually did some math. A 25% CAGR for 8 years is a total return of 596% versus a 5.42% CAGR, which yields around 153% over the same period. Now here she's trying to tie her flawed thought process into today, saying that the Fed is ignoring deflationary signals. The problem here is she just hasn't pointed out any real deflationary signals whatsoever in her past tweets. Like, even if she thinks the Fed raising rates could lead to deflation, we sure as hell haven't seen any signals to indicate that today. She pretty much tried to manipulate some numbers to point out any similarities she could find between the conditions for the 1920s and the 2020s without just flat saying that they're both the 20s, so she thinks they will be the same. Now, her final thoughts in these last couple of tweets here are pretty much just a continuation of some of these thoughts, summarizing by saying that the Fed should root against depression and for the roaring 20s. Again, as if one didn't directly cause the other and pretty much just blatantly virtue signaling, trying to guilt practical people into agreeing with her idealistic views on the market, as she usually does. Now, I'm not one to say that her predictions on inflation and the Fed are wrong. I am confident in saying that her predictions are still dangerous because of how she applies her ideas to investing. I mean, her views are so macroeconomic that I don't think she's ever actually stopped to look at financial statements of any of the companies that she owns. I mean, for example, RK, which is her main fund, has an average price to earnings ratio of 65. When you take out a size outlier like Tesla here, its PE is left at 238. The S&P average tends to be around 16 to 20 for reference. So she's overpaying around 10 times per dollar of earnings than you would with a typical investment in the S&P. This is getting a little bit off topic, but I think what Cathie Wood and any of her followers need to understand is that it's easy to sit on your high horse and say you're investing in all these popular or innovative technology companies that will help people, especially in good times with low interest rates like 2020 and 2021. But what's hard to do, and what Cathie Wood is clearly unwilling or unable to do, is to invest in companies whose future growth isn't already entirely factored into their stock price. So that just about sums up my thoughts on these recent Cathie Wood tweets. Let me know what you guys think, and thank you for watching.